Hi, everyone. Ben Driggs here, Navigate Financial. We appreciate your being with us today. DJ is going to be with us kind of in the background, and I'll be leading the discussion. We're going to be talking about alternative investments. There are several people new to the webinar listening this morning, so let me give you some background. We do this webinar once a month on the second Tuesday of each month, 10 o'clock Mountain Time. Last year, we talked about like what we call the 11 areas of financial planning, and that's, lending and investing, cash flow, estate planning, retirement planning, and the like. This year, what we're doing is each month, we're just taking it each month at a time and talking about things that are relevant. So a couple months ago, we talked about gold. Last month, we talked about some of the stuff that's happening in the global, politics and the economy and some of this stress that we're experiencing. This month, we're not talking about anything that is too time specific. I was tempted to talk about what's happening in Iran and what is happening and how that's impacting, but I think we might push that to next month because we still don't know kind of how this plays out. So we're just going to be talking about an ordinary topic this week or this month. But it's a topic that I've considered for some time. It's alternative investments. Some of the things that we hear about, we hear these buzzwords, venture capital or hedge funds and these things, but we don't really know what they mean. Most of us don't know what they mean or how they might work into a portfolio. So I thought we'd talk about that today. If you have a question, just raise your question. I'll be monitoring these questions as we go along. And we're really happy to have you here. So we will end at half after the hour. It is 2 or 3 minutes into the half hour. So let's get started. Again, if you have any questions, just raise them in the chat. So, alternative investments. Before we jump in, let's remind everybody about the 3 traditional investments we talk about all the time: stocks, bonds, cash. So these are the traditional, and they constitute most of the investment universe. They are stocks, which are also called equities. That's when you own something, you own an asset, you own a company. When we're investing in stocks in the context of an IRA or a 401k, brokerage account, this sort of thing, we're buying publicly traded companies, but we also might own, like I own Navigate Financial. It's just a little baby company, but I own the shares in that. So in that case, I have equity in Navigate Financial. Bonds are also called fixed income, and that is when you're loaning to some institution, a government, typically government bond or a corporate bond or municipal bond. And in return, they're giving you interest, and then eventually they'll pay the principal back, assuming they don't default. And the last one is cash. So let's talk about alternative investments. What are these? They're not the traditional. They kind of have different structures. They have different objectives, different strategies that are being employed. And we'll be talking about 10 of them today. Typically, they've been kind of reserved for more sophisticated or high net worth clients, more experienced clients or investors. But we're seeing over time, these are becoming more mainstream, such as cryptocurrency. I put that in the list. And that's kind of a newcomer to the player. So we have different structures and strategies. They can use leverage. They can go both long and short in the markets, sometimes, meaning they make money when it goes up and they make money also when it goes down. Most of us, when we're investing, say in the stock market, we only make money when it goes up, right? So you can make money when it goes down. It's a little more tricky. You can make a lot more money, but you can also lose a lot. So most people don't do that. They are less liquid. They're more complex. And the last bullet here is we're expanding access. More and more people are getting involved in them. So what are the benefits of alternative investments? Diversification is a good one, and you can read along with me. There are different reasons why they go up and down at different times. And so we have a lower correlation. So when you have, it's kind of like building a rope. So if you have only one strand, it's less strong than if you have 10 different strands all woven in, some moving up, down, twisting around. The more things you have in a portfolio, the tighter that becomes. Ultimately, you're going to get probably the same rate of return, but you have more things happening to kind of keep that glue together. Unique opportunities, we can maybe invest in some things that traditional stocks and bonds don't invest in. And lastly, we have the opportunity to get more money potentially. The rise of alternative investments here, this chart shows over the last 10, 20 years, we've seen a lot of growth. More and more money is going into alternative investments, and that has relevance on possible outcomes, which we'll talk about in a minute. In general, even though there's more money coming into the space, you would think, oh, that means more of an opportunity. But typically, the more money that is competing for the same amount, like there are only a finite number of companies and opportunities out there. So let's say there are 100 companies to invest in, and now you have literally, as you can see here, 3 times as much money going after those same 100 companies. It's more difficult to make money in the alternative space than it has been historically. So let's talk about them. We're going to lead off with real estate. Real estate, we're all familiar with that. You have residential, you have commercial, industrial, and mixed use are the typical categories. Real estate is unique for a couple of things. Number one is you can leverage when you buy a house. Let's say you're buying a $500,000 house. You only have to put in 10%, we'll say. So you can put in $50,000. Well, let's say the house goes from $500,000 to $1 million. You've only put in $50,000 and you've made $500,000. So that's an example of leverage working in your favor. That's a unique characteristic about real estate that most of the other investments we'll be talking about don't have. You can get income, and that's another benefit of real estate. And you kind of have 2 things. You get the cash flow coming from the property that you own. Well, not a rental property, not your own home, but on a rental property, you're getting cash flow. And at the same time, the property is appreciating over time, hopefully, right? So this combination of leverage, cash flow, and income really makes real estate a unique opportunity and a really good thing. You can invest it here through direct ownership. You could buy a house, you could buy a rental property, or you could buy into a fund. And there are public funds called REITs, Real Estate Investment Trust, that are buying typically big, there's a portfolio of hundreds of big properties, skyscrapers or, sports arenas or, office buildings, what do you call it, like a shopping center, stuff like that. And those are typically the big space. If you just want to buy a few homes, that is typically, you're just going to have to do that on your own. The next are commodities. Commodities, as we know, are physical things that drive the economy. The first category we put is metals. We talked a couple of months ago about the unique properties of gold. I consider gold more of a currency or a financial asset. They act as a hedge against inflation. Gold, we've seen this rise as currency challenges are happening throughout the financial markets in recent years. That bodes well for gold. Then you have metals that are what we call industrial metals, copper, I don't know, rare earth things, lithium, things that are used for cars and whatnot. We're seeing a lot of a race for these kind of metals, and they've been to run a lot of the modern power grid and a lot of the technologies, AI and things like that, are really pushing prices up in that space of energy. And then agricultural products is another example of commodities. Let me hop over and check to see if we have any questions. No questions. Okay. Be sure to ask any questions if you have them. Going to go to hedge funds. They are, so as I mentioned, you can go long and short, and meaning you make money when it goes up or when it goes down. And you can typically use leverage. So you're not putting in $100 for dollar. Right now, just so you know, when you invest, and let's say you put in $1,000 into your IRA or into your 401k, that $1,000 is buying $1,000 worth of an investment. That is not leverage. Leverage is, as I mentioned earlier, the example of a house. You put in 10% to buy, a much bigger thing. That's leverage. And leverage works very nicely when things go up. But as we learned in 2008, when things go down, leverage has an inversely negative consequence. So who can invest in hedge funds? And this goes for a few of the other asset classes that we're talking about, some of the other alternative investment categories. Typically, these are accredited investors. You have to have typically $1 million of net worth. And the account minimums, they used to be, $250,000, $500,000 for that you'd need to put into the investment. Those have come down to $100,000. And now we're seeing pretty commonly, you can buy into these investments at $25,000, $50,000, something like that. So that's a big trend. You have other things that are called, that are a little bigger, qualified investors. You have net worth 5 million. So those start to be moving into high net worth institutional investors. And here are a few examples on the right-hand side: long, short, global, macro, arbitrage. We're not going to get into these details, but that gives you a sense of some of these categories. Private equity, you've heard that a lot. Essentially, private equity is the same as stocks, but I mean, they are stocks, but each company out there, in the world, in the United States, each company is either privately owned or publicly owned. So when we have something that is publicly owned, anybody can buy and sell that stock freely. I can go buy Amazon or Google or Tesla. I can sell it, and that's a publicly traded going back and forth. But not everybody can buy Navigate Financial, right? Navigate Financial, it's its own little private company, right? So private investments and private equity is going and buying private companies, privately owned companies, putting into a fund typically. So you buy all these, and then you create this fund. Now, what typically private equity does is they're typically targeting companies that are in distress, or that companies that the investors think they can do a better job at. So these are kind of the sharks. These are kind of the people that get the bad rap, because the company's struggling to make money, and you have some outside investors saying, this company has a lot of potential. It's fallen on some hard times. It has poor management. It's bloated. It has too many people. But the potential is really there. So what we're going to do is we're going to go in and we're going to buy, hopefully at least 51%, because it's all about control. We want to control what's happening with this company. So they go into the company, they amass a whole bunch of money, they buy 51%, for example, and then they start cleaning things up. These are the guys that are going to come in and do the layoffs. If you're a company that has been acquired by a private equity firm or a private equity fund, you're nervous, because your job is definitely on the line. But these companies serve a very good purpose. They encourage competitiveness and sharp business practices. But the idea is you would bring all this money in, go in there, fix it up, clean it up, make it much more profitable, and then turn around and sell it back to another private equity fund, or sell it to an IPO or some sort of a exit strategy. Short term, go in, you're mean, you're tough, you clean it up, you control it, and then you get out of there as quickly as possible. Private equity. Private credit. Let me check if we have any questions. No questions. Okay. Private credit is analogous to the private version of a bond, right? So you have debt. Sometimes companies are trying to run their operations, and they can go to a bank, right? That's borrowing, that's credit. But sometimes a bank imposes certain restrictions that the company doesn't like, or they're just too restrictive. Banks are quite conservative in their lending practices, particularly after 2008. So they say, bank's not loaning us money, but we have a really good idea. We have a need for this money, but issuing a bond might be, that's something they could do, a corporate bond. But another thing they could do, but that's typically a public thing. So they say, you know what, let's go to the private markets. We know a whole bunch of people are willing to loan us money, and we will pay a little above what a public bond market is paying. And that's the attraction from an investor's standpoint, is that you can buy into a pool of debt that you're loaning, companies money. They're going to give you money back, their interest, just like it's a bond basically. And it's kind of an enhanced bond. Some of the challenges, though, is that you don't have quite as much transparency. And so this makes that a little tricky space, but it has become more and more popular. We're seeing tremendous asset flows into the private debt, private credit space, to the point people are starting to get nervous that perhaps we have another 2008 brewing, because people are loaning all these monies to these companies. Well, what happens if the economy goes belly up? Now they're not going to pay them back. So you can read some of the reasons why it's growing. We have venture capital. Venture capital is a fun one. This is the fun money, the seed money. You're investing in a new opportunity. My daughter, who lives in the Bay Area, she's an attorney at a venture capital law firm that specializes in venture capital. I'm going to see her actually tomorrow. So looking forward to seeing her, and as a law firm, and what she does is she helps companies structure these deals, put things together. She just sent an article yesterday about a company that they just helped. It's now public, and they raised $1 billion. It was in the Wall Street Journal. They have these three young, literally teenagers, and they have this great AI tool and stuff like that. And so they need private money that is going to come in. It's going to be first, it's going to be angel investors, friends and family, and then it's going to go maybe to like Series A, Series B, Series C. You kind of move up as you have more and more money. Typically, you don't have a lot. These companies are not making too much money. Many times they're losing money, but it's early stages. Innovation, definitely it is swing for the fence. And, most of the companies fail for sure. You're banking on, hey, 9 out of these 10 companies are going to fail, but one of them is going to be the next Google and we're going to get rich. So not very speculative. But it's not for the faint of heart. And typically you're going to be relying on a management team to help you with that. Derivatives, we won't go into them. You can read these. These are options, futures, swaps. You are, these are mainly financial. You're not really taking possession of these things necessarily. You're not directly owning, but you're using them to, use some other, make some other, money from trading, some arbitrage or stuff like that. Cryptocurrency, we're not going to go into that. As I mentioned earlier, this has grown a lot in popularity, as we know, and tends to be, well, cryptocurrency, it's its own thing. I think before the end of the year, we will be having a cryptocurrency webinar. Managed futures, I have a love-hate relationship with managed futures. I typically hate managed futures. I've had a few clients in them in and out over the years. They typically just sit there, do nothing. And then when the market falls apart, they go up. We've seen this in everything in .com. We saw it in 2008 when the markets went down 40%. They were up like 40%. And there are a couple of other examples over the last many years. So you would think that that's really good, but most of the time the market is not having these dramatic moves to the downside. But they go long, they go short, they're investing in all sorts of different things. Very difficult to find out, but basically it's a trend. The thinking is the longer the trend, the more likely the trend will continue. So right now they are long, I'm certain they're long in stocks because we've had a few years of stock markets up. So they'll say, hey, that's going to continue for a while. Collectibles, kind of fun category to round it out. You've got, these different fine art, trading, rare coins. This really few people get involved in that. These are collectors and people that have their own set of unique characteristics, rare books and whatnot. So we won't talk about that other than to acknowledge that there is a category, an alternative investment of these collectibles. And people, particularly wealthy people, some wealthy people as a hobby and as an investment, absolutely have millions and millions of dollars invested in these kinds of assets. And I think it's kind of fun, if you can make the same amount of money, why not own a cool collection of something? So risks and considerations, you have limited liquidity. They're not good for liquidity. Unlike a stock and an index fund or something, we can get money cash at the bank within a day or two, liquid. Typically, you have liquid challenges, high fees, and you have performance fees in many cases. So if the hedge fund makes, a lot of money, they're going to take a higher percentage. That is not typically the case with other investments. So that can eat into your gains. They're complex. You're going to need accounting and financial expertise, limited transparency. You don't really know how much liquidity these funds have. You don't know how they're doing. You may not know who's running them. You don't know what's in the portfolio. You don't know how much money they have in case there's a problem, So limited transparency is a big shortcoming. And then lastly, you need to be wealthy typically to invest in them. So how have these different asset classes performed over time? We have 5 minutes left. We're going to finish with 2 slides. Let me check to see if we have any questions. Okay, no questions. So hold on just a second here. Okay, so be thinking about these. Which ones do you think have done the best? The next slide will show what we've seen in the last 5 years. Okay, stocks, frankly, the winner of the US stocks in the last 5 years. International stocks have done almost as well over the last 5 years as well. So global stocks, venture capital, that's your startups, commodities, thanks to gold and precious metals in the last year or two, private equity, which is your private version of US stocks. So my thinking in the last 5 years, it's like, well, if you're going to invest in stocks, why invest in private equity when you have more paperwork, less liquidity, less transparency? Just buy stocks. Forget the private equity thing. But people like that because historically private equity has been kind of it's done well historically. Hedge funds, real estate, private credit, you're seeing a lot in the 5, 6, 7% range. But really the big winner has been stocks over the last few years. The bond market has struggled in the last 5 years because as interest rates have gone up, that's put a lot of pressure on the bond market. Even yesterday, inflation isn't going down, so the Fed can't lower interest rates. We've got rising oil prices. Oh, that's inflationary. We've got tariffs. Oh, that's inflationary. So all these inflationary pressures they're kind of the enemy to the bond market, and they prevent the Fed from lowering interest rates. The thing that is going to lower interest rates, I know there's a little tangent, is if we go into recession, and then you're going to see the bond market. So if you're thinking all the problems that we're seeing out there are going to translate to recession, then stay the course with bonds. Do not despair. Almost all of this negative return for the bond market happened in 2022. For the last couple of years, bonds have been just fine. Okay, looking at more of a long term for the last 35 years. Okay, the big winner, venture capital. Venture capital is where people have made the most money, followed by private equity. Then you have stocks, real estate, hedge funds, and you work your way down. Bonds at 5%. That starts to get more of a long-term historical rate of return. I think that these are pretty consistent. But what I wanted to point, cash, when we talk to clients, we say, hey, what can you expect in cash in the long run? It's 3%. And I usually had a conversation yesterday with someone who said, okay, the investments are really 3 to 8, from ultra conservative or not even investing cash to 8% for your stocks, 3, 4, 5, moderate, it's going to be 6-ish in the long run. That's what you're really getting with a stock bond portfolio, the last 35 years being a little better than long-term historic averages. But what I wanted to point out is venture capital, private equity, hedge funds, private credit. If you look at these are more attractive than going up one slide. You've seen that venture capital, private equity, hedge funds, and private credit have not done as well over the last 5 years. And I think the reason being, I mentioned it earlier, you just have so much money coming into these spaces. They used to be in kind of the domain of the privileged, very wealthy people who had access to some really cool deals. No one else had access to them. They were complicated and whatnot. But because they're just becoming so routine these days, they're just kind of starting to get long-term average rate of return, no different than any other investment. Okay, it is 10:30 on the dot. I see no questions. So here are disclosures. Thank you very much for joining us today. Have a wonderful spring ahead. Call us if you have any questions. If you have any questions about, hey, Ben, I want to get involved, do some alternative investments. Let's buy some, venture cap. Let's buy into a venture capital fund. Obviously, we can have that conversation. Take care. Thanks for joining us, and we'll see you in 1 month, second Thursday of April at 10 o'clock Mountain Time. Take care. Bye.